Thank you. Well, Stephen, I've learnt a few things this morning. I've just heard from Pauline, if I heard correctly, that my superannuation will top up my pension, but I still will be doing it pretty tough when I retire. Of course, Joe has told me I've got to work for another 20 years before I retire, so I'm starting to feel a bit pessimistic. And then Clive, I think, said this morning I've only got a 1 in 3 chance of living until I'm 70. Not sure Clive's figure was quite right on that one either, David, but yeah, good start to the morning. And to make matters worse for the audience, I've been asked to talk about banks. I'd like to start just a little bit. I've been asked to talk about the robustness of the system, which is a fair topic to talk about. Clearly, we do have a robust system. A few years ago, we went through one of the most rigorous stress tests you could possibly have. It was called the global financial crisis, and we did pretty well. I think generally we tend to overestimate actually how well we did do. It was a more near-run thing than perhaps the general public understands, and I'm sure David would vouch for me that there were a few scary moments back in 2008 where I was working at NAB at the time. I used to see senior bankers who understood what was going on a hell of a lot better than I did, walking around looking rather pale and with beads of sweat on their forehead, which was always slightly disturbing. But nonetheless, the system came through the crisis well. And since then, we've done a lot, both domestically and internationally, to make sure that banking is even more robust. We've increased our capital levels. So basically think of those as the protection against losses that banks make. That's been driven by both regulatory change, but also by markets as well, who are wanting to see better capitalised banks around the world. We've also increased our liquidity. So this is basically, how much money you've got on hand when people may want their money back. We've increased that significantly with fancy things like the net stable funding ratio, which is coming in, and the LCR, the liquidity coverage ratio, and all these sorts of fancy things. So look, we've done a lot to make our system even more robust, and this is an appropriate response. Even though we've had some concerns or criticisms about some of the detail. So we've got a strong and we've got a robust banking system here in Australia, and that's actually something that we should be very pleased about. We don't necessarily have to love our banks, but we do need to be pleased about, we should be pleased about the fact that we've got a strong and stable system, because a strong, stable financial system, banking system, is actually a precursor to having a strong economy. And many of you will be aware of those countries around the world that had banking systems fail and the consequences of that, and David touched on that a little bit earlier. Now, those changes have not been without flow-on consequences of various types into the way banks operate, into the way that the markets operate. So, for example, the focus on liquidity in particular and being more stable has meant that the competition in Australia for deposits has increased substantially. That has increased through the financial crisis as banks look to fund themselves more from deposits, and that continues today. In fact, today, in broad terms, we're basically paying about 2 percentage points more for deposits than we would have pre-GFC. So for those of you who do have a few savings, you're probably earning about 2 percentage points more than you would otherwise have been earning. And I think one of the things that we haven't talked a lot about in Australia is, while this wasn't the intention, one of the consequences of that is that through this period of low interest rates, to some extent those with savings in terms of cash in the bank have been protected, their incomes have been protected by this intense competition. So that was one dimension. There have been some structural changes as well. I think it's fair to say that in a relative sense at least, the non-major banks are in a weaker competitive position than they were prior to the GFC. There have been some structural changes that have made it harder for the non-major banks to compete. That's not to say that we don't have competitive markets. In fact, the highlight of my year so far is to get my 23 bank CEOs who represent the members of the ABA to all sign off on a submission to the Financial System Inquiry where they all said, yes, markets are competitive, but nonetheless we do think there may be things that can be done to enhance competition further. Now that'll be down to individual banks depending on where they sit in the market, but one of the things we do want the Financial System Inquiry to look at is what can be done to enhance competition further. So there have been changes, there have been consequences, but overall we do have an even more robust system than we did prior to the GFC. Now that doesn't mean that we can be complacent. In fact, we should be very alert to not becoming complacent about that, because we can see some challenges ahead which could go to how strong our financial system is. One of them I've touched is competition. We need to make sure that competition remains sharp, that all markets are competitive. It's competition that drives better prices, better services, innovation in banking, and we need to make sure that that continues. There's a few other areas that we've highlighted with the financial system inquiry. The first one seems a little self-serving and a little obvious. Sorry, just excuse me for a moment. And that is to say that whatever the financial system inquiry comes up with, we don't want it to actually damage the things that are already working. Now, at one level you might say, well, you know, the Bankers Association defending the status quo is fairly predictable. But we do think it's a fairly important point to make, is that our system by and large is actually working. And we need to be very careful in addressing areas where there may be concerns, that we don't lose sight of the need to protect what already works. So that's our first position with the financial system inquiry. Our second area is we identify one area where in future we may have some challenges. Now, even the banks themselves have got different views about the extent to which this issue may be an issue, but given its importance, we think it should be addressed. And that is funding of the economy. Not just funding of the banks, but bank funding is critical because we are a major component of funding the broader economy, but funding the economy overall. One of the lessons we learned through the GFC is that sources of funding for the economy, sources of funding for banks can be disrupted and can be subject to volatility, which can drive prices as well. It's not clear that, there's no clear and present threat to funding of the economy at the moment, but given that a funding into the economy is the oxygen of the economy, it would be prudent for us to make sure that no matter what the world throws at us in future, and no matter what the demands of the Australian economy, they can be met, that funding can be provided. So we want to see the financial system inquiry recommend that we put in place some prudent measures to basically mitigate against those risks. And that simply means making sure that banks and others in the economy have access to the widest range of high-quality funding sources as possible. We need to look at whether there are regulatory or tax impediments to some of those funding sources, such as deposits. We need to look at the question of the place of superannuation in the economy and the contribution that superannuation is making to economic growth, not taking away from its sole purpose, but looking at whether there are impediments to superannuation playing a more active role. So that's an important area we'd like to see the financial system inquiry focus on. I've talked about competition, which is another area. A fourth area we want to see focus is regulation. Again, fairly predictably, I represent the private sector. We're not particularly enamoured of regulation, but the debate is really not about whether there's too much regulation or whether regulation is good or bad. The debate has to be about the quality of the regulation we have. One of the characteristics of the financial system is it is a system. It is a complex system. Now, one of the things that this means is that when you make a change in a part of a complex system, it will inevitably have consequences for other parts of that system, often in fairly unpredictable ways. We would like that to be at the core of how regulation is made around the system, the recognition that almost inevitably there are going to be, it's a hackneyed phrase, but it's useful, unintended consequences whenever you make regulatory change. At the moment, what we see is regulation largely being done around particular issues or in silos. You know, over here we regulate for stability, over here we regulate for consumer protection, and we regulate for competition and various other things, and often without any real regard for how these things flow in and affect across the whole system. Excuse me. If anyone wants my cold, they can come and shake my hand afterwards. So that's another area that we need to focus on. The final area is probably one that when we started out looking at the financial system inquiry last year, we knew it would be an issue, but we probably didn't understand the extent to which it was going to be an interesting challenge, and that is the role of technology. Now, all of you are bank customers. Even those of you with credit union or with some part of the banking system, you will have seen how technology is already changing the way all of you do your banking. I imagine most of you in the room do internet banking. You'll have seen things rolled out like chip and pins in credit cards. You'll see tap and go cards and all these sorts of things. That is just the beginning of the change that technology is going to drive in the banking system. We are going to see rapid and ever faster change in technology, driven by technology, in the way we do our banking. And that's largely going to be a good thing. I'm convinced that a lot of that change is going to be beneficial for customers. It's going to empower customers. It's going to make banking a lot more convenient. It's going to sharpen competition just by virtue of the fact, if nothing else, that information is going to be a lot easier to find. And just to give you a very, very simple example, and it's pretty old technology now, but it still demonstrates it, and that's being able to go on the internet, go to a site like Canberra, for example, and there you've got all of the credit cards laid out for you, all of the home loans, all of the personal loans, what the price is, what the various features are. You know, the old days where if you wanted to shop around, it literally meant walking from branch to branch or looking in newspapers for advertisements have gone. If you want a better credit card, just go to Canberra, you can see everything there, you can see the product you want, you can just ring up the bank and start that process. So that's going to empower customers a lot more, and we can see that continuing. Already the banks are telling me that the technology that they're rolling out, the various apps and things, are very much being driven by customers. It's no longer a case that banks are looking at the efficiencies they can gain from technology. They're running flat out to keep up with customer demands for new products and services and better convenience and everything. So we know there's going to be a lot of change. The other thing we know is that technology is going to allow a lot of new players to come into the marketplace, particularly in the payment system. People are already used, or many people are already used to paying through things like PayPal. Google is in this space, Square, various other things out there. You know, the thing that in a few years' time we'll hear about that is currently being cooked up in someone's back shed in their backyard. I mean, all these things are going to transform banking. Now, the reason I emphasise all of that and spend a little time on it is the FSI is about what the government needs to do to make sure that we continue to have a good financial system. There's a really tough challenge at the core of the technology issue, and that is that technology is going to change banking faster than regulators can keep up with it. It'll move faster than the regulatory process. You know, if ASIC, for example, has some concerns about something, by the time they convince Treasury to convince the Treasurer to convince Parliament to make a change, it'll all be too late. The bandwagon will have moved on. So this is a unique challenge for government to make sure they can find a new way of regulating the financial system that allows us to get all the benefits out of technology without introducing systemic risks or undermining customer protections. So those are the 5 areas we want the financial system to focus on: making sure we don't stuff up what already works well, making sure we can be confident that the economy is going to get the funding that it needs in future, making sure we have competitive markets and we sharpen that competition, making sure we've got better regulation, and then finally resolving this issue about how do you regulate in a rapidly changing technology-driven world that we're going to be facing. At the end of the day, though, there's one simple thing that the financial system inquiry needs to do, and it needs to, through the inquiry and the government's response and ultimately Parliament's response, give us all confidence that the financial system is going to continue to serve the Australian economy in the future as well as it has in the past. Thank you.